costs incurred must relate to invoices, payments made to an organisation or a supplier external to the partnership. So that's one of the key points that we need to make sure is that projects do not engage with a partner to undertake any project-related activity. You have to engage with an external supplier. In some instances, we're aware that projects might have entered into service level agreements with either partners or other departments within their organisation. If that's the case, the recharge invoice isn't regarded as a real cost. The real cost is the actual invoices that have been received and paid by the partner. So if you have entered into service level agreements, that's fine, but you just need to make sure then you are actually presenting the actual costs that fall behind that service level agreement, because you have to remember the service level agreement in most cases hasn't been entered into as a result of a public procurement process. That's why we need to see all the actual real costs that fall in behind that activity. There are 4 different cost categories: staff costs, external expertise and services, equipment and infrastructure and works. And they're the 4 cost categories that you will be claiming your real costs against. As there was also within this programming period, there's been a greater emphasis from the Commission to utilise more simplified cost options. The Commission are very keen to ensure that we make things as easy for projects as possible. So they've introduced, this time round, there was some of them in the previous programming period, but there's greater emphasis now on the use of simplified cost options. And all projects will have some simplified cost options within them. This takes the form of either flat rates, unit costs, or lump sums. And one of the key points as well, again, to remember is that when expenditure has been incurred by a simplified cost option, it cannot be included in any other cost category as a real cost. So again, if that's the case, that would be regarded as double funding. So the cost categories, staff costs. Fact sheet 1 of the programme manual gives you information that is based on the article within the regulations. So staff costs are direct staff that have been employed by your project. And there is 2 links or 2 conditions that must be satisfied. The first thing is there needs to be a legal link between the project partner and the employee. So that's the form of a contract of employment. And also then the transfer of monies. So unless a person working on the project has documentation to satisfy both those conditions, they cannot be claimed under staff costs. And one of the things to note is that if a project does employ agency staff, those staff costs aren't considered eligible under the staff cost category, because the legal link isn't actually between the employer and the employee. It is between the recruitment agency and the member staff. And also the transfer of monies doesn't go directly from the project to the member staff. It is going via the recruitment agency. So that for projects is definitely a change from the approach we took in the previous programme period, but this has been based on guidance that we've received from the Commission. So we need to ensure that projects are aware that recruitment agency staff are not eligible under the staff cost category. All projects also will have an office and admin a cost category, and that is covering their indirect costs. And fact sheet 2 in the programme manual provides you information in relation to this. So all projects, with the exception of investment area 3.2, will have a 15% flat rate, and that is based on their direct staff costs. Projects within investment area 3.2 have a 40% indirect staff cost or indirect flat rate, and that is to cover all their other cost categories. So projects that are under investment area 3.2 will only have a staff cost category and a flat rate of 40% to cover all their project implementation activities. Travel and accommodation this time round is being paid as a flat rate, and that is one of the simplifications the Commission have introduced. Details of this are included within fact sheet 3. But in the main projects, with the exception of investment area 3.2 and 4.3, will all get a 7% flat rate of their direct staff costs, and that is to cover all their travel and accommodation of their staff. projects within investment area 4.3 are able to receive a flat rate of 4.5% of their staff costs. One of the things that you need to bear in mind is that during the verification or management verification checks on the travel and accommodation budget, we will need to satisfy ourselves that there is travel and accommodation, travel costs are being incurred by the partner. That is also one of the things that would have been checked by the JS whenever your project was being assessed, to ensure your project did include some travel activities. If your project hadn't have included any travel, the flat rate wouldn't have actually been approved for your project. And then just through the implementation and through the verification, this will be checked. No receipts and documentation will need to be reviewed. The verification of that will happen through your partner reports, and where we will be able to just receive confirmation from the project themselves that travel has been undertaken. And again, there's two different flat rates that we need to make sure then any costs in relation to the office and admin or the travel and accommodation of your staff do not feature in any other cost category. External expertise and services is covered in fact sheet 4 in the programme manual, and this relates to the external services and expertise provided by a person or a body which is outside the beneficiary organisation. So the types, this covers the types of external expertise and services that your project will claim will be very directly linked to the activities that your project has been approved for. But it can include things like accountancy fees. It could include research, procuring, meeting accommodation, various things that you need to have an external expert to come in and provide some services to your project. If your project doesn't have an external expertise and services budget or a limited budget, you need to make sure that you're living within that, because that will be the boundary by which you'll be able to claim your expenditure. And again, there needs to be a direct link for that expenditure to the purpose of your project. Equipment, it's covered in fact sheet 5 of the programme manual, and that is related to costs for the purchase, renting and leasing of equipment by the project partner. We need to be mindful that when you're purchasing equipment, that if it has an economic life greater than the duration of your project, you need to be considering leasing or renting it rather than the purchase of equipment. If you were going to consider the purchase of equipment, only the depreciation costs would be eligible. And for the programme itself, we regard anything with an economic life of greater than 1 year or a value of either £1,000 sterling or euro, excluding VAT, to be regarded as an asset. So you need to make sure then that you consider carefully what equipment that you're purchasing and the need for that and how that directly relates to and is needed to implement your project. Infrastructure and works is in fact sheet 6 within the programme manual, and that relates to the purchase of land, building permits, building materials, labour and any specialist interventions that are required for your project. A few of the projects also then have simplified cost options, which then don't feature in any other cost category. But in relation to investment area 1.1, there is the project preparation lump sum, and details of that are included in fact sheet 8. The Innovation Challenge Fund, which is investment area 2.2, there is a number of simplified cost options, and the details of that are included in fact sheet 9 of the programme manual. And also then in investment area 3.1 formal, there is a unit cost on children completing the Shared Learning Together programme, and details of that are included in fact sheet 10. And again, just to reinforce the point, any expenditure included on or covered by a simplified cost option should not be presented in any other cost category. As well as eligible expenditure, there's also ineligible expenditure, and details of that then are included in 6.3 of the programme manual. So the first thing is costs must be declared under the correct cost category. So you need to be making sure that you claim it under the correct cost category when you're doing your partner reporting. If not, even though that the expenditure should be eligible, it won't be considered eligible under that cost category and will ultimately be rejected. Cost must not be declared more than once. That's your double funding. So that's in relation to the simplified cost options, but also as well claiming items expenditure on a real cost basis in multiple partner reports or across different other of the actual cost categories. costs covered by a flat rate cannot be reported separately. Additional alternative sources of funding other than PEACEPLUS. So if an item of expenditure has already been covered by another source of funding, it shouldn't be declared under PEACEPLUS programme. Interest on debt isn't eligible. Purchase of land. So there's an amount exceeding 10% of the total eligible expenditure would be regarded as ineligible. So there's a limit set by the regulations on if you had to purchase some land, and that relates to the total project costs. A change in this programme period, VAT is where VAT is recoverable on projects with the costs of 5 million euros or greater is ineligible. But if your project actually is less than 5 million euros, even though that you were able to claim that VAT back from the revenue source, those costs are eligible to be recovered. And that is a simplification that has come from the Commission this time round. Fines, financial penalties and expenditure on legal disputes and litigation are also considered ineligible. Costs of gifts. Now, this is a change from the previous programme period. There previously was a lower threshold that a cost of a gift could be considered eligible, but this time round the Commission have deemed that any gifts are not to be funded by European funding. Costs related to fluctuation of foreign exchange rates are also ineligible. And this is one thing to bear in mind, because a lot of our projects are implementing and incurring costs in sterling, and you'll be reimbursed in euro. So you need to be mindful that any current foreign currency exchange rate costs that you incur, those actually can't be claimed through the project. Also engaging a project partner to deliver goods and services. I've touched on this earlier on, but you need to make sure that anything that you're doing in your project, that you are engaging with an external provider to provide that. If one of your partners, for example, you did want to, they want to maybe undertake an element of the project activities, your only option is then to transfer the budget to that partner and actually ask them to deliver that element of the programme on a real cost basis. You cannot include them in a procurement process and ask them to deliver those works on a commercial basis. Activities completed or payments made after the project end date, which is outside the eligible period, are also ineligible. Section 6.5 of the programme manual deals with public procurement. Processes, and public procurement is the process used to select and contract with providers of goods or services or works. This is one that the Commission have acknowledged that this is an area where most irregularities come from. So we have to be mindful of making sure that there is quite a lot of things that can go wrong, and that's why then I think that if you're having good planning and being aware of the pitfalls will help you implement your project successfully and be able to undertake a successful public procurement. So all PEACEPLUS projects must comply with public procurement legislation. That's the important thing. Principles of transparency, non-discrimination and equal treatment must be respected. Most common errors are lack of transparency and equal treatment, being unclear what you're doing, and we'll touch on this later on, but about how to avoid that. Discriminatory criteria, artificial splitting of contracts, conflicts of interest, and then failure to comply with public procurement requirements equals financial penalties. And that's one of the things that as a programme we want projects to avoid having to have financial penalties levied on them. So public procurement regulations, this is covered in section 6.5.2 of the programme manual. So there is 4 levels of public procurement rules that need to be considered, and it's always the more stricter rules always must apply. So the European Directive, Public Procurement Directive. So there's one that relates to goods, services and works, and which would cover the majority of our projects. But then we also have to be mindful there is another directive which relates to water, energy, transport and postal services. Underneath then the European rules, And what would happen is the Public Procurement Directive 2014-24, that was actually then instilled down. Member states then were to bring them into their national rules. And in the UK, the national rules for the Public Contracts Regulation 2015 did replicate what the EU Public Procurement Directive 2014-24. But as a result of the UK leaving the European Union, the Public Procurement Contracts Regulation actually will be replaced by the UK Public Procurement Act 2023 in February 25. So one of the things we need to be mindful of now is that projects still need to ensure that the fact that they're in receipt of European funding, that they have to comply with the European Public Procurement Directive. So where the UK Procurement Act actually now steps away from some of the things that's included in the or the changes within the Public Contracts Regulation 2015, we need to be mindful of that, and project will have to put in place extra steps to ensure full compliance. One of the main areas that we will be providing guidance in a further version of the programme manual is about contract modifications, because the rules of contract modifications in the new Procurement Act actually are different from the European regulations. In the UK or in Ireland, the national rules are the Public Procurement Guidelines for Goods and Services, version 3, October 2023, and that replicates the Public Procurement Directive. So it's a cleaner cut for partners or lead partners based in Ireland. Underneath then that, each project then will have their own procurement or their own partner rules. So as a project in making sure that you operate in good governance, you need to make sure then that you're abiding by your own rules. And then in relation to that, then there is also then programme specific rules. And that's the 4 different levels, and they always that we have to take is that the most stringent rules apply. One of the things to note that I should have said in relation to the UK Procurement Act is that advertising a contract on find a tender service is not a substitute for using the official journal of the European Union, and projects will need to ensure that then they put in that extra step to comply with what the requirements of the programme are. So the advertising requirements of the programme, these are covered in section 6.5.3 of the programme manual and also included within Annex 2 of the programme manual. So full tender action is required for contracts above £30,000 or euro. And that's where national procurement websites need to be used, or the regional press. All procurement should be on a cross-border basis, and that is advertising in Ireland and Northern Ireland. So you need to make sure that all projects projects we are taking that will be operating on a cross-border basis. The only exception to that is projects who operate on a single jurisdiction, and they then they are allowed then to advertise their contracts then just within their area. So the national procurement websites that the programme allow projects to use. In Northern Ireland, that can be either eTenders NI or eSourcing NI, and in Ireland, that's eTenders IE. In relation to then, so the EU and public procurement rules continue to apply post December 2020 for the UK, Northern Ireland, including access to the official journal of the European Union, or the OJEU as we call it for short. Contracts above the EU threshold must be advertised in the OJEU, and that is both the contract notice and the contract award notice. And remembering that both those notices have to be published for it to be a compliant process. The EU thresholds are expressed in euro only. So if there's a contracting authority based in the UK or Northern Ireland, they should convert their sterling contract values, excluding VAT, into euro using the Commission's monthly exchange rate, and that's in for euro. A link to that is provided within the programme manual. So if you were planning to publish a contract in this month in November 24, you would go into the info euro and you'd see what the exchange rate is for sterling to euro for that date. You would convert your sterling value to euro, and you would then be able then to determine if your contract value is either above the threshold or below the threshold, to know if you have to advertise it in the official journal of the European Union. And again, advertising on find a tender service is not a substitute to advertising on OJU, even though that find a tender service is the high value portal for high value contracts within the UK. So the procurement thresholds, these are detailed in Annex 2 of the programme manual. So contracts or items expenditure between £200 sterling to £5,000 sterling, a price check is required from 2 competent suppliers. And what we mean by a competent supplier is somebody who ordinarily provides those goods or services. For contracts valuing between 5,000 and 30,000, a minimum of 3 quotes are required from competent suppliers. What I would say is that if you know that there is a lot of suppliers in the market, do not restrict yourself to only asking 3 people to quote for your piece of work. You want to make sure that you're achieving best value for money for yourselves, and also ensuring that you get a return that you actually can assess and be able to demonstrate that you've obtained value for money. In a lot of instances, you'll be sending out requests for quote via email, so it's quite easy to actually include 10 or 20 names if you have it in when you're sending out your terms of reference request or your seek for quote. So I would definitely encourage projects not to go with what the minimum requirement is, because you need to make sure that you're able to assess and show that you're demonstrating value for money. Contracts above 30,000 euros up to the EU threshold, then full tender action is required. As I said earlier on, that entails advertising on the public procurement websites or using the regional press. And again, full tender action it's expected you do this on a cross-border basis unless you can demonstrate and have documented that your project is a single jurisdiction project. Projects then that are over the EU threshold. So these are thresholds that have been set by the Commission, and then depending on the type of project that you are or your organisation, if you're public sector or if you're determined being one of the entities identified in Schedule 1, there's different thresholds apply then for supplies or services or for works. Again, the EU thresholds are only expressed in euro and the values are excluding VAT. So if the value of your contract is felt to be close to or above the EU threshold, you must be advertising on the official journal of the European Union and retain the evidence of that. So the lead partner have a number of responsibilities, and these are outlined in section 6.5.5 of the programme manual. So the lead partner is responsible for ensuring there's compliance with public procurement procedures for the entire partnership, ensuring that both EU and national rules on procurement have been followed. All tender documents to support expenditure claimed must be retained and available for management verifications and audit, and this includes pre-existing contracts and frameworks. We know from previous programmes, a lot of projects maybe would be utilising existing frameworks that maybe or contracts that have been let and awarded, not specifically for the PEACEPLUS programme. So you need to make sure whenever you're deciding to utilise one of those contracts that your activity is within the scope of that procurement exercise, and also that all the procurement documentation is readily available and can be accessible and viewed for audit. If you know that the documentation isn't going to be accessible, you should not be using it, because otherwise you will be incurring financial penalties for not providing the information. Again, failure to retain a complete audit trail will result in financial penalties. Financial penalties then are given for breaches of procurement and guidance, and these can be severe. Penalties can range from 5% to 100% of the contract value, and the most common penalties relate to inadequate advertising, accepting late tenders, amending or introducing new selection award criteria, not publishing contract notices on the contract award notice if your contract is above the EU threshold, and also modification of contracts beyond the approved limits. This slide shows sort of some of the financial penalties that are recommended by the European Commission. The Commission actually have outlined a paper and details that are included at the bottom of the slide. So this is for non-compliance for the rules on public procurement, and we use these as our guide for all of our public procurements. So the first part of it relates to public procurement for tenders and publications. So you can see there is, if you, for example, didn't publicise or seek the number of quotes, you can receive 100% penalty on your contract. If then there has been inadequate advertising, where a contract was advertised to some extent but not fully, a 25% of the contract value will be applied. Also, artificial splitting of contracts to avoid publication. So where you've been trying, maybe that a partner have decided to reduce the contract value to keep it below either full tender action or below the EU threshold. If that has been identified, 100% of the contract will be deemed ineligible. If there's been insufficient time for potential bidders to obtain tender documentation or restrictions in obtaining these tender documents, penalties can range between 5 and 25%. Non-compliance for time limits for receipt of tenders, penalties can range between 10 and 100%. Failure to publish or sufficiently describe the selection or award criteria, including weightings, can result in a penalty of 25%. Use of criteria which deters bidders can result in a 25% penalty as well. And also the scope of the contract being insufficient or imprecise, meaning the scope being unclear, can actually be perceived as being potentially restricting competition, and a 10% penalty can be applied for that. There's also penalties then in relation to the selection and evaluation of tenders. So the selection criteria were modified after the tender was opened or the criteria was incorrectly applied, a 25% penalty. Using criteria different to that stated in the specification or using additional unpublished criteria is a penalty between 10 and 25%. Insufficient audit trail, lack of transparency to justify the award. And if there's lack of transparency and justification, it can be 25%, or if there's actually refusing to have access to the documentation, can result in a 100% penalty. If there's been negotiation during award process or the modification of a tender during the tender valuation to favour a bidder has been identified, a 25% penalty can be applied. Irregular prior involvement of bidders can result in 25% as well. Procurement processes with negotiation, where conditions of the contract or scope have been altered, can result in a 25% penalty. Unjustified rejection of abnormally bids is a 25% penalty. And then where conflict of interests have had a direct impact on the outcome of the procurement process, can result in 100%, which means that the entire contract then would be regarded as irregular. There also then is recommended corrections in relation to contract modification. So these can range between 25% of the initial contract value and any extensions, and or else 100% if different thresholds haven't been breached. And again, this is one of the things we bear in mind, and we will give further guidance in advance of the new Public Procurement Act coming into force in February 25. So you can see there is very clear penalties that have been described by the Commission that we would then have to apply, and it would be applying to projects if we find any of those breaches identified when we're checking the procurement documentation. So within the section 6.5.7, there's a section that talks about public procurement life cycle. And this really looks at the different stages. So the first stage in the life cycle is about the planning, identifying the scope of the contract, which should be unambiguous and clear what has to be achieved. Estimating the contract value, including any potential options for modification, is vitally important. Selecting the appropriate procurement approach based on the estimated contract value, be that if it actually is full tender action or if you have to go to the route of going the official journal. Ensuring that all potential bidders have equal access to the relevant documentation is key as well. So examples of errors within the planning phase relate to underestimating the contract value, where modifications bring the contract value over the threshold for the procurement approach adopted. So this is where if you had identified maybe your contract only to be €28,000 and then you were going to modify it then, and maybe it brings you then over into the threshold of €31,000 or €32,000, which means then that you really should be moving into the next procurement action. Artificial splitting of contracts needs to be bear in mind, is where a number, how do you go back? Artificial splitting of contracts, where a number of smaller contracts have been included, should have been included in one larger contract. So an example of that on a very simple basis is if you are procuring a room hire for a meeting, but you know that you actually need to have, you're doing a training course and you're having 10 meetings. The entire cost of the contract is the cost of the 10 meetings, not just the one meeting itself. So that's an example of where you would be splitting something into smaller contracts. Irregular prior involvement of potential suppliers also can be a situation which can occur where you've involved somebody in the maybe market research and then also involving them in the preparation of the tender documentation. You need to ensure that anybody involved in the initial fact finding is not involved in the tender documentation preparation. The second phase is about the preparation. So if potential suppliers were involved in the first phase, they should not be involved in the preparation of tender documentation. Basic principles must be observed, and that is equal treatment, free access to information, open and fair and transparent, and non-discriminatory competition. These are the key things that you need to be bearing in mind in ensuring that your process respects those principles. Tender documentation is the core to ensuring adherence to public procurement rules. So examples of errors in the preparation phase are principles of public procurement have not been respected, failure to describe in detail the selection and award criteria, including restrictive or similar selection and award criteria. Selection criteria is discriminatory. Failure to provide information on how the award criteria is scored, and referring to a particular brand or specific supplier in the specification. And also then conflict of interest. Next phase then is the publication. So partners must ensure that tender documentation complies with the EU and national procurement rules. And the errors that can happen at this point are the lack of publication, where contracts are above the EU threshold, not publishing the contract notice in the official journal, non-compliance with time limits for receipt of tenders, failure to extend or lack of publicity when you're extending time limits when tender documents have significantly changed, excessively short deadlines for submission of quotes or tenders, for above the threshold contracts, deadlines not complying with the legal provisions that are outlined in the regulations. And also then if there is any clarifications during your process that you're not sharing identical information with all potential bidders. Because you have to ensure that you're not favouring any bidder over each other. The final stage then in the project procurement life cycle is the selection and award. And the types of errors then that relate to this are missing conflict of interest declarations, modification of tender scope during the assessment phase, failure to state the selection award criteria in the terms of reference, discriminatory criteria on selection, unlawful selection criteria, selection criteria not being proportionate to the scope or the subject matter of the contract, modification of selection or award criteria during the assessment process, the wrong application of the calculation method for scoring the award criteria that was described in the terms of reference or specification, the introduction of additional award criteria during the assessment phase, lack of transparency, equal treatment during the assessment phase, negotiation during the assessment phase, and then also a record of decision to appoint is missing or insufficient audit trail has been retained to evidence that. And also then the final thing is conflict of interest having an impact on the assessment phase. Now, there probably could be other errors, but these are the most common ones and the ones that are worthwhile noting what the errors are. So at least then that you can then maybe put in steps to place to make sure that you don't fall foul of those. So the key documentation then, just to reinforce that needs to be retained for your management verifications is your terms of reference, evidence of seeking your quotes, advertisements, that depends on the threshold, evidence of quotes and tenders received prior to the deadline, report on assessment of the quotes and tenders, so how that assessment process was carried out, the letter of acceptance, the contract award notice, if it was in the OJU, the contract, including any amendments or renewals, and again that those must, any amendments or renewals must comply with public procurement regulation. Evidence that payments match the contract, proof of delivery for goods and services, and that the invoice and proof of payment have been retained.
Hi, good morning, everybody. So you've heard from Emma there about how you incur your expenditure in a compliant manner, and because we obviously want you to be fully reimbursed for all of your expenditure. So I'm going to talk to you about partner reporting, and that includes the reporting of the expenditure that you've incurred. So I know we have a mix of projects with us today. So we have some projects who would have previous experience of EMS, and then we have projects who wouldn't have. So basically EMS was our monitoring system that we had in the previous program, and in this program period we've got GEMS, and basically GEMS is an electronic monitoring system that includes all of the information to do with projects for the full lifetime. So that's straight from application stage right through to submission of reports and the payment of those reports. So that's the program, that's the monitoring system that we're using in this program period, is GEMS. So chapter 5 of the program manual is about partner reporting. So we have probably a mix also of projects that just have a lead partner, and then we also have projects who will have lead partners, a lead partner and partners. So I'll be talking about both of those terms. So project reporting is an essential part of the management of your project. Both the lead partner and the project partner have responsibilities in project reporting. There's two aspects to our project reporting. One is to facilitate the communication and monitoring of the project. So that's important to our JS because they'll be checking against the progress that you have reported and the evidence that you have provided to check that you are progressing against your approved application or project. And then the other aspect to reporting is where you tell us about the eligible expenditure that you have incurred whilst delivering on your project. So first of all, I'm going to tell you about a partner report. So a lead partner and all project partners must submit a partner report. So there's two sections to a partner report. One area is about the activity. So the activity section of the partner report is a project management tool for the lead partner, and it's imperative that it is fully completed by all partners, lead partner and all. Partners should build their partner reports throughout the reporting period, so that it's not something that's done basically at the last day, so that it enough time has been put into it to make sure that it's complete and includes all of the information required. So by building it throughout the reporting period, that will ensure the timely submission of the partner report. So as I say, there's two sections to it. There's an activity section where you talk about your progress and you upload any evidence. And then there's an expenditure section to it where you enter all of your items of expenditure and upload all audit trails against those items of expenditure. Now we have prepared a user guide which will help all project partners to submit these partner reports, and that will be something that will be released very soon. It's very detailed and hopefully you will find that very valuable. So all projects will have a reporting period which will be determined by the start date of their letter of offer. It's normally 3 months. So if you have a start date of 1st of January 25, your first reporting period will likely be January, February, March, and on the 31st of March 2025. So during that period, that reporting period, you gather all of your information about your progress and your expenditure. And when you have it complete, all partners will submit that partner report on GEMS. So once you have it submitted, the control function can kick in, and that's our external controllers in this program. So the controllers will start then, and they will examine all of your expenditure. They'll examine the expenditure that's due for sampling. They'll test all of the expenditure and make sure that a compliant process has been followed and that it's eligible against your approved project. So they'll apply that sampling methodology and management verification to each partner report. And then when they're content with it, they will certify it. So at that point, if you're a project with a lead partner and 5 partners, so you will end up with 6 certified partner reports. So the next step when you have your 6 certified partner reports is the responsibility of the lead partner then. So they must create, the lead partner is responsible for creating a joint finance report. So the joint finance report reports on all the financial aspects of the project. It's going to include all certified partner reports for all partners. And they have already been certified, as I said, by the controller. So the lead partner will draft it and start building on the partner reports and all the information needed to go in there, and then they will submit it. When they submit it, the JS will do their checks at that point. So they will check the information within it. And when they're content with it, they'll pass it to our MA, who will also do a range of checks. And when they're content, they will pass it to the accounting function for payment. So a period of 12 weeks is available from the end of the reporting period. So we talked there about a reporting period being January to March 25. So the 12 weeks starts from the 1st of April. And that a period of 12 weeks is available from the end of the reporting period to the submission of the finance report. So when we, in the previous slide, so the end of the reporting period was the end of March. So from the 1st of April, you have all of that time to take to submit your reports, your partner reports, get them certified and get a joint finance report submitted. So as well as submitting a joint finance report, lead partners are also responsible for submitting a joint content report. But I'll just go back one slide here. So a 12-week period is available for project partners to submit their partner reports for the controller to complete the management verification. So the project partner submits the reports as soon as all expenditure has been defrayed from the bank. The controller applies the risk-based sampling methodology and carries out the management verification on expenditure selected for verification. The controller concludes the control work and certifies the reports, and all of the above then must be completed within 12 weeks, which is 12 weeks from the end of the 31st of March. So there's 12 weeks available there, but by the controller and the partner working together, there are time savings that could be achieved there. So it's important to get into a good organised way of working with your controller to take any time savings that you can within that so that you get paid quicker. So timely verification of expenditure by the controller largely depends on the completeness and accuracy of documents submitted by the project partners, who in turn must also be ready to respond quickly to requests for clarification from the controller. So as I said in the previous slide, the lead partner must submit a joint finance report, and they also must submit a joint content report. So this is a report that sits out to the side. I suppose it reports on all of the progress against activities. There's 4 weeks allowed there from the end of the reporting period. And this talks all about, this report contains information on the overall project progress at work package and activity level, including information on achievements, indicator progress, communication, involvement of target groups, project management, as well as any problems and deviations that the project might be incurring. So it's basically telling our JS that all of the information and progress that the project is achieving. And then the lead partner will use the information that was in the partner reports to help compile this report. And something that's important here is that the outputs and results should only be reported when they are fully completed. So part completion of outputs or results shouldn't be included. So a couple of things that are very important. The information keyed into GEMS must be complete